Options selling is a trading strategy in the stock market where an investor sells options contracts that give the holder the right to buy or sell a particular stock at a predetermined price, strike price, before a specific date, expiration date. There are two types of options contracts: call options and put options. Call options give the holder the right to buy the underlying stock at the strike price, while put options give the holder the right to sell the underlying stock at the strike price. When an investor sells an options contract, they receive a premium payment up front, which is the price paid by the buyer of the option for the right to buy or sell the underlying stock. The primary motivation behind selling options is to generate income by collecting the premium payments. An investor can sell options contracts either naked or covered. In a naked options selling strategy, the investor does not hold any position in the underlying stock and is exposed to unlimited risk. In contrast, in a covered options selling strategy, the investor holds a long position in the underlying stock and is hedged against the potential losses. When selling options, an investor needs to determine the strike price and the expiration date of the options contract. The strike price is the price at which the underlying stock can be bought or sold, while the expiration date is the date by which the option must be exercised. An investor can choose to sell options with strike prices that are above or below the current market price of the underlying stock. Options with higher strike prices are called out-of-the-money options, while options with lower strike prices are called in-the-money options. If the price of the underlying stock remains below the strike price for a call option or above the strike price for a put option, the options contract will expire worthless, and the investor will keep the premium payment. However, if the price of the underlying stock moves against the investor and exceeds the strike price, the investor may have to buy or sell the stock at a loss. Options selling can be a high-risk, high-reward trading strategy. The potential rewards are the premiums collected, which can be significant, especially if an investor sells options on a regular basis. However, the risks are also substantial, as the potential losses are unlimited if the price of the underlying stock moves against the investor. Therefore, investors must carefully assess their risk tolerance and market expectations before using options selling as a trading strategy. In addition to generating income through premium payments, options selling can also be used to hedge against other positions in the stock market. For example, an investor who holds a long position in a particular stock may sell call options to hedge against potential losses if the stock price declines. Similarly, an investor who holds a short position in a particular stock may sell put options to hedge against potential losses if the stock price rises. Options selling can be a complex trading strategy, and investors must be familiar with the various terms and concepts associated with options contracts. They must also be familiar with the market conditions and the underlying stock's volatility to make informed decisions about which options to sell and when to sell them. In summary, options selling is a trading strategy in the stock market where an investor sells options contracts that give the holder the right to buy or sell a particular stock at a predetermined price, strike price, before a specific date, expiration date. The primary motivation behind selling options is to generate income through premium payments. However, it can also be used as a hedging strategy. Options selling can be a high-risk, high-reward trading strategy, and investors must carefully assess their risk tolerance and market expectations before using it.